Welcome to the weekly update, where I'll go over the action in the market for July 29th through August 2nd, and then we'll see how things look for the week of August 5th through the 9th. We're seeing some weakness. When we look at the daily charts, we are negative in the short term. We were hanging out around the 50-day moving average in the intermediate term, but turning more negative. A lot of our charts were just not looking very friendly, but that support level was holding. Then on Friday, we ended up falling down to the 100 period moving average. And so that's also having an impact on the weekly charts as we're seeing some weakness coming into the market. When we look at the bigger picture, though, we are still positive, and we don't want to lose sight of that. Before I get started, please look at the daily videos if you want to keep up with what's really going on. That's the foundation of my analysis. There's also a PDF in the description below this video and every video that I post. Some folks find that helpful to download and look at these slides as well as the charts that I go through. Every day, I update pivot points on the YouTube community tab, both that apply to the whole month and those that apply only to that particular day. I do have a private Facebook group that you're welcome to join. Not really active, not a lot of members. If you want to have some back and forth with me, you're more than welcome to join that. I also have a program, and that's where you get the most interaction with the things that I teach and with me. But if you still want to have interaction and you're on Facebook, feel free to join that group. I do really go through and watch the comments. I don't get a lot of comments on my videos. It's probably because I usually shoot the middle with my analysis, and you really can't read a lot into the charts other than positive or negative. But I get a lot of comments on Rumble. They get these experts out there who think that they're social media gurus or something. They after attending some kind of webinar or something, and I have to go through and play whack-a-mole getting rid of those. But legitimate comments, yeah, those are always welcome. You want to have a back and forth with me that way, you are more than welcome to do that. Sometimes I do have a problem with uploading. I post not only on YouTube, but also on Rumble. I had an internet outage for about 10 hours, and it's why this video is being posted later than usual. I can't do anything about that, but if it's around the time that I'm supposed to have a video uploaded and you can't find it on one platform, jump over to the other one and see if you can find it there. And here is the link to Rumble. I do have a program that I mentioned. This has launched. It's still free for right now. If you want to find out more about it, there are links that will take you to the website, also links that will take you to videos that you can learn more about the program. I'm going to be locking that down at some point in August. It's kind of a logistical nightmare setting that up right now because of my current living situation. All right, here is how I approach the videos that I post. All of the videos that I do over the weekend, those are on the outside. They're just meant to be augmented into the daily video. That's the real foundation of my analysis and commentary. Another YouTube channel that you might want to check out is Chris Shivako at Shivako Capital. He's a money manager where I'm an educator. He puts out a video each week, very knowledgeable, uses a lot of moving averages. He does go back and look at, okay, what happened 20 years ago? And then is it comparing to what's happening right now? That kind of thing. I do that to a degree, but probably not as much as he does. But some of you will find his videos very useful, especially longer term. Also, another YouTube channel that's interesting is the Kindle Report. Been around a long time, has some unique indicators, has some insight, also has a newsletter that you can subscribe to. That is Bob Kindle. Okay, so let's go back and what are some of the things that happened this past week? We were down 2.06% on above average volume. We're supposed to be dropping off in volume. I mean, this is the dog days of summer, July going into August. People are supposed to be at the beach or on vacation or wherever they go. And we're seeing volume still remaining pretty healthy. We are still positive in the bigger picture with the technicals, but we are showing some weakness. And this week, it was about inflation and interest rates where the Fed decided not to change rates, and that was not expected. They didn't really front run the idea that, yeah, we're probably going to cut rates in September. They didn't do that either. But when you take it all together, what Chairperson Powell said was not anything new to the markets. We're seeing some weaker than expected economic reports coming out. And now, instead of bad news being good news to mean, okay, maybe the Fed's going to come in and cut rates just to stimulate things, The weakness that we're seeing, especially in the employment situation that came out on Friday, that's causing some concerns. And that's why we're seeing a real push on the negative side. And now bad news is actually becoming bad news. We want to see if that will continue. Also, geopolitical concerns. Not only politically what's going on in the US, that's kind of working its way through right now, but there could potentially be an escalation of things in the Middle East. Hasn't really impacted the market, at least yet. We'll see if at some point it does. Now we're going back and forth with this recession debate again. We were pretty much hearing, I mean, there's always people that are going to say recession's coming, 50% decline in the stocks, all that. There's always the perma bears that say that. But the economic reports were suggesting, okay, we might be able to have that soft landing after all. Well, with the latest economic reports coming out, that throws that into question a bit. And now the debate is leaning a little bit more, at least for the short term right now. Okay, are we going to go into a recession? Is that going to be what actually ends up happening? I don't take a stance on this. About once a month, in fact, I'll be posting it on the website. I do a recession video, and I, just like I do in all my other videos, I list the charts that say, okay, this suggests that we could go into a recession. Here's some charts that suggest that we won't. And then we just kind of watch things play out. Instead of getting real dogmatic about it and declaring something, we just watch things as they unfold and then adjust accordingly, because the market adjusts to this as well. And in the daily videos, that's where you see these little swings going back and forth and different adjustments. And we can pretty much follow along as things are happening. Instead of coming up with some forecast and either being right, wrong, or having to change it, we just watch it as it unfolds. Okay, our trend is still weakening. We're below the moving average, and I'll show you that chart. We're still positive. The green line is above the red line, but the green line is declining. Okay, here are some bullet points. The stock market really had solid declines this week, pretty much across the board. Everything got hit, except for some more defensive areas that we'll talk about here. And this has to do with these growth concerns. Okay, we don't mind things slowing down, but if they're really turning more negative as far as economic growth, that's when the market becomes more concerned. On Wednesday, the Fed voted unanimously not to change rates. We're at 5.25 to 5.5 right now. The market is anticipating some kind of a cut in September, 100% there, and I'll show you those charts. And then after the Fed met, the press conference by Fed Chair Powell, it didn't really say anything that made the market really respond to that. There was a pretty muted response. There was a gyration up, but by the time we closed on Wednesday, we pretty much were back to where we started right when the announcement was initially made. And then Thursday's economic releases, they came out and it's like, okay, are we going to be slowing down more than what was thought before? And now there's this thing going back and forth. Well, the Fed's been keeping rates higher for longer. Is that going to cause some kind of a problem? Should they have already been cutting rates by now? And then the employment situation report, this also was weaker than expected. And instead of being good news, it ended up being bad news. Interest rates, these are really going down, but you have to look at the context. You would think, okay, declining interest rates would support stocks, and the dollar was down too. Those two things lately have been giving support for stocks to go up. Well, the context now is interest rates may be going down because of economic weakness, and that's not necessarily good news. So we ended up closing at 3.79%. We dropped under 4%, where a week ago we were at 4.2%. That's a big move down in the 10-year yield. And then earnings reports, some were good, some were bad. Some had good reports and they tanked. Some had bad reports and they went up. That's the way it always goes. You can just roll the dice with earnings reports. Okay, so for the week, the Dow was down 2.1%. The NASDAQ got hit really big, down 3.4%. The S&P was down 2.1%. And small caps, which had been seeing this love lately and really moving up, well, they fell 6.7% this week. I've been watching this chart for over a year now, where we're coming down into the lower end of this blue line. This goes from 1966 to 1982, and what did inflation do at that time? Now, we never really follow this completely. Sometimes we go along on the basic idea. The reason I keep showing this chart is look at what happened after. Now, we don't know if that's what's going to happen this time, but we just want to be prepared. We might be in a lower inflationary environment with interest rates going down, but that can change as things start to hit the economy, and that can produce some really high inflation. We just want to have that in the back of our mind right now. Okay, now we did drop under that 4.02% according to RenMac, where now if this stays below 4.02% at 3.79% with the 10-year yield, that could start helping corporate profits at some point. But if it's because of economic weakness, there may be some rough patches between now and when things start to turn back more positive. Okay, and then this is what we want to keep an eye on. We're really watching the employment situation, the whole area. And one of the things that comes out are those folks that have been unemployed for over 6 months or 27 weeks. All right, this is starting to go back up. This is long-term unemployment. And I highlighted here November 62, just in case you wanted to review what that was. But we are going up, and that is causing a bit of a concern. And then when this goes up the way it has in the past, quite often that will lead us into a recession. Doesn't mean that's what's going to happen now. We just want to keep an eye on this. And then Isabel Net, we're still looking okay here with the earnings going forward. They're all looking positive going out into the future. And then volatility, I've showed this chart many times. It's the toll that we pay to invest, where it's very common. We're down around 5% or so now. That doesn't happen quite as much as a 3% decline. We're wondering, are we going to head all the way down like we did a year ago? We had a 10% decline from the highs in July to October. That ended up going down to 10%, hitting significant support, and then we bounced up out of that. Is that what we're going to see right here? We're right at some pretty major support right now. We are oversold in the short term and somewhat in the intermediate term. Did we overdo things in Thursday and Friday session? Is that going to produce some kind of a bounce? We just have to watch it unfold as we go. All right. And I'm not a big pattern type person here, but I have heard a few people say this. This is a daily chart of the S&P. And is this some kind of an island top? Okay, if we went up a little bit more, they would come up with some other pattern. That's why I'm not really into this as much, because there's so much subjectivity that goes into this. But if we are seeing this kind of a pattern, that could suggest that there's more weakness going forward. Okay, then we also keep an eye on all employees and temporary help services. This is going back up. We dropped below the red line, but did not go into a recession, where other times we have gone into a recession. That's one of the unique things about this period of time that we've been in. We still want to keep an eye on this since we're still below the red line. And then looking at payrolls as well as the ISM manufacturing. That's when we make things. This is a concern. This is what partially helped the market decline this past week, was we're coming in below 50 and declining. When we're below 50, that's showing contraction in the economy. And we're also seeing a pullback in the non-farm payrolls. They're still positive, but they are really coming down from where they were at before. We just want to see, is this going to continue? All right. And then right now, it looks like the market is pricing in a 25 basis point or 1/4% decrease or rate cut in September. That's what they're anticipating. And then global central banks cutting at fastest pace since COVID. I don't like this since whatever. Okay. But there are other central banks around the world, and this is a 3-month cumulative measure here, that have already been cutting rates. Not the Fed, but other central banks have been doing that. And then FactSet, this is kind of their real busiest time. If you go to their website, and they do have a video there. I didn't watch it myself. It's like, okay, how do I want to be bored for 20 minutes or however long the video is? But some of you that really pay attention to earnings, you might want to go to their website and watch the video. It was like a Zoom conference where some guys just, that's all I saw was the picture. I'm like, okay, here's one video I think I'll skip. But they're reporting profit margin 12% above for the second time since, and I'm not into this, since 2022. But this is healthy right now, that we are looking more positive this way. And then this is energy, where we're still seeing things pretty weak here with gas refining and marketing, where the other areas of energy are still quite strong. but they do see it still being negative in the fourth quarter of 2024 and then going up after that. So that's also justifying the energy sector hanging in there fairly well these days. And then this is the update. As of Friday's close, 75% of S&P 500 companies have reported. 78% of those have been above their estimates, and then they get into the 5-year, 10-year. When you take it all together, right now we're at 4.5% above estimates. So that's looking fairly healthy. Whether the stock goes up or down, this is just looking at their earnings reports in solitary there. Okay, so here is the chart, and it looked like, okay, maybe we're gonna do okay this week. Monday, not much of a real reaction here. And we were having a really difficult time, and I was pointing this out. You see, way last to Thursday on July 25th, and then we hit this area of overhead resistance, overhead resistance, overhead resistance, overhead resistance. The market was having a really difficult time breaking through that. Then on Tuesday, we came up to that level, reversed, and then ended up going down. But we were able to bounce off the 5,400 level and see a little nice things going into the close. Then Wednesday, okay, things are looking pretty good. We gapped higher, we went up and doing okay. Then this is when things started to reverse. We actually had a higher open on Thursday, went up, hit resistance, reversed, not only came down. You notice this gap back here on July 23rd? We filled that gap. And what sometimes can happen is once that gap is filled, then we reverse and go in the other direction. And that's what happened. We ended up really having a decline. We did bounce up off of the lows. Now, we gapped much, much lower in Friday's session. But as I've been pointing out in the daily video, the market was already down over 1% even before the employment situation report came out. It was more earnings, what's going on in Asia, and difficulties with the Tokyo market, the Japanese market declining. So we were already weak, and then Europe was weak. And then we get the employment situation report coming out. And yeah, we declined after that as well. But a lot of those declines were in place before the report was even released. So we really gapped down, but we were able to set up some kind of a base here around S2. This is really close to the 100 period moving average. So we'll see if the market can do something with this, maybe bounce up off of that in the upcoming week. All right, so this is just for the 5 trading days, looking at the indexes. Every index was down. We had the small caps down the most. The Dow was down the least. So these are different than the numbers I went through earlier because it's only the 5 trading days. It's not Friday to Friday. This is going back to the beginning of the year. Even with the declines that we've been seeing, all of the indexes continue to be up for 2024. Looking at the sectors, and I sorted this because we were down. So we had the tech sector being down the most, and energy was down. Discretionary was also down. Even the financial sector, which is hanging in there fairly well, it ended up being down. Industrials and then materials, where we had utilities up. And we're watching this. You can make a couple of cases here for utilities. One is that this is more of a defensive play, and they like interest rates going down, and they tend to do better. Okay. The other thing is that maybe utilities are more growth these days because of the extra need, especially for electricity, and it's for AI and all of the things that are going to happen there. And it's for all the mining that needs to take place with cryptocurrencies, which has already gone on for a while. And the different policies that are being implemented is likely to make electricity anyway more scarce, with this whole push over to green things. So that's why we're seeing some strength here. We don't know if it's a legitimate move up because things are looking better, or is it moving up because folks are getting into this as a more defensive posture. Okay, then we go through the scooter score here, going from 0 to 100. The better the score, the better looking that particular sector. And we have utilities in the lead at 99. And then real estate, they like interest rates going down too. Those are the only 2 that are in the 90s. We have staples. That's another defensive area. And healthcare is also a defensive area. This is what the market usually gets into when it's getting ready for a decline. So we've been watching this for quite a while now. We're going to just keep watching this over and over, where we had tech and consumer discretionary being down the most. Okay, so here is the week. Just for the different sectors, we're kind of split down the middle with utilities, real estate, staples, healthcare, and then communication. Okay, that's a growth area, but these other areas are more defensive. And then the other sectors ended up declining. Going back to the beginning of the year, we still have communication, and now utilities are in second place, where the financials and tech is now gone negative. Now, these measurements here, I just do them as raw scores. So you're probably going to see something a little bit different than if you compare it outright to the S&P 500. Then we look at a thing called the relative rotation graph. This is remembering back to your geometry class, where you have an x-axis goes along the bottom, the y-axis goes up and down. The strongest areas are up in the right-hand corner. The weakest areas are in the lower left-hand corner. And we're seeing some weakness here when we're looking at tech, where it's been a stronger area, but now it's starting to turn back down. Utilities have continued to be strong. Now, this goes over the last year, not the last week or month or 6 months. This is a whole year here, and it's compared against the SPY. So we have been seeing some weakness overall, even though utilities had a pretty good week. It's hard to see here, but we did turn and start to go back up here. And we're seeing some improvement with real estate, as well as discretionary a little bit here, and then healthcare. At least real estate and, well, healthcare anyways, defensive, where these other areas are starting to turn up after having been weaker. And then this is just a chart showing how tech is still doing the best. And then real estate's been showing some improvement, discretionary, healthcare, utilities are more or less in the middle right now, but showing some improvement. And then all of the other sectors are negative still. Then we break it out looking at the major market indexes, because we're just kind of, this is like bumper cars. My goodness, they're going all over the place. We have the S&P, which has been pulling back, but still looking strong. Utilities, which had been showing some weakness, are now coming back. And then we have the NASDAQ 100, which has been one of the stronger areas in 2024. It's pulling back. And the S&P 100 is also showing some weakness right now. And we're seeing a little bit of improvement here, but still pretty weak with the mid caps. The small caps were seeing a lot of improvement, but didn't have a very good week. This is the Dow Jones Composite Average, which is showing some improvement. And transports, they like lower interest rates too, and lower gas prices, lower oil prices. So this has also been showing some recent strength. So looking at the chart here, we have the S&P 100, the NASDAQ 100, utilities in the S&P, they're doing about the best. And kind of in the middle area, showing some improvement, are transports, the composite, and small caps. Where mid caps, which earlier in 2024, mid caps were one of the strongest indexes for many weeks at a time. The end of January and going forward from there for a while, mid caps were looking the best. Now they're looking the worst. Okay, sentiment. And this is something that's just kind of a chuckler. It's called predictit.org. I don't pay attention to a lot of the surveys that come out about who's going to win the presidential election. I go to something like this just because people have to actually put down money to bet here. I don't participate in this. I just kind of keep up with this. And we're seeing a little bit of a shift here as Kamala Harris is this love that's coming in from the media right now, and talking just 2 weeks ago, they talked about she was the worst vice president in the history of America. Now they're talking about what a genius she is and all the great things that she's either done or going to do. And so she's getting a little bit of bump out of that. And we are going to have the Democratic National Convention coming up later in August. But Trump has now gone into second place, according to this. But this changes many times throughout the day. All right, looking at our different sentiment gauges here, fear and greed. We were in the neutral camp on Wednesday, and we fell all the way down to the lower end of the fear camp. And to show you the chart, we were above 50 and kind of hanging in there fairly well. We just dropped off in Thursday and Friday session, and we're getting close to this 25 level. This is when we start entertaining the idea of using this as a contrarian indicator. And we tend to follow that a little quicker here because the bigger picture is still that we are in an uptrend. But we could come down and drop below this and actually stay down here for a while if we see more weakness. Active asset managers, after being extreme positive a few weeks back, they did drop off, but a week ago, and that's where these results come from, they did see a bit of an improvement. That's probably going to decline in the next report. And this is where we saw a big change. The VIX has just been hanging out at really low, complacent levels. Not in Thursday and Friday session. We really shot up. We got above 20 now, and this is where we start to see negative annualized returns. And we also shot up with the bar chart. Even though we closed off of the high, we actually got above 30 at one point as the market was just completely freaking out on Friday. But still, this is way up from where it has been for quite some time. And this is what we normally see on a seasonal historical basis here into August going forward until about the early part of October or so is when we see the VIX typically start to go up. And we're seeing that at least to this point. And then looking at this sentiment indicator where we had been looking more positive, it really dropped down below this dashed line as more pessimism has been coming into the market lately. And the Ulcer Index, it's really spiking up on the daily chart. It is going up here on the weekly chart, but still below the moving average. And this is not necessarily producing a concern right now. This is the spread between risky, like junk bonds, and not as risky bonds, like government bonds. When this really starts to go up, that's when the bond market is seeing an awful lot of fear. And we're just not seeing that, at least yet. Also, the latest rating from Investors Intelligence, they came in at 3.81. They dropped down over 4. Usually they get to be extreme when they get above 4, which is what we saw a week ago. And this is going back up for right now when we do a ratio between cash and the tech sector. When this is going down, that means the tech sector is outperforming, and it is bouncing back up as tech has been under pressure. And we look at the RIDEX bear bull ratio. When this really spikes up, folks are bearish. Now, this is as of Thursday's close, but most of the folks were still in bullish funds. So they didn't have a very good day on Friday. And they'll probably react to that over the weekend, and this will likely spike back up. And then the latest reading from the American Association of Individual Investors actually ticked down. No, I take that back. It actually went up a little bit, but we're not getting an extreme reading, and still the moving average continues to go up. So we tend to ride that while it's happening. Now, this is probably really going to drop in the next survey after the week that we just finished with. Then this actually should have gone with the risky to non-risky spread here, where this is inverted, where we've been going down with the S&P. We've been going up. Remember, this is inverted with that risk yield here, and seeing a little bit of an increase in fear. We'll keep an eye on this to see if this continues to go down, which means fear is going up. And then the VIX, which is also inverted on this chart, just really shot up, which on this chart means it went down. Okay, looking at the latest reading for GDP now, where we're coming in at just under 3%, according to the Atlanta Fed. The different forecasts that we look at are about 2.5% to the upside and about 1.5% to the downside. But the takeaway for right now is GDP is still forecasted at being positive. And that's what we're seeing on this chart as well. It's when we start to see negative forecasts when we get more concerned, because part of the definition of a recession is we have negative GDP for 2 consecutive quarters. This is not really causing any concern at this point. Now, this was also as of Wednesday, but this is the Chicago National Financial Conditions Index. When we get above the black line, that's when we're concerned. We're still declining here. And then we did have this, the real-time SOM rule recession indicator. This is coming up to the black line. We're starting to get a little bit nervous, and the market sees this. There was a lot of talk about this on Twitter or X, and this is a little bit of a concern right now. If we continue to go above the red line, that quite often leads into a recession. This is one of the pro-recession charts that we're looking at right now, but there's other con-recession charts that we can also look at. And then here's the smooth U.S. recession's probabilities. It's actually declining, but this chart is now a few days old. And then we have the Brave Butters Kelly Leading Index. It still continues to decline. We get a little concerned when it continues to go up. Then here's inflation. It did readjust here with the inflation now casting as the week was carrying itself out here. Now this is, we're done with the July 31st meeting, so I don't have any more charts to show you there. We're currently at 5.25 to 5.5. As of Friday's close, there's a 78% chance that they're going to cut rates 0.25%. And there's also a 22% chance that they're going to cut them 0.5%. And I've even seen 1.5% floated out there. I mean, okay, we'll see. And then this is how things have changed over a period of time. And you can see this was Friday. This was a day ago, a week ago, a month ago, where we were starting to see folks really going into the camp of the 0.5% cut. Well, that quickly switched back in Friday's session. Then looking at November, that's the next meeting after this. It'll be November 7th, where they're looking at a 75% chance that rates will be at 4.75 to 5. That would be a 0.5% cut from where we're at now. And there's even some folks that are suggesting that we might see more than that. There's a lot fewer folks that see that we may go down 0.25%. So yeah, and this changes every day with all the economic reports that come out. And this is how this has changed as well, where you can see the big move from one day to the next is how the market is trying to adjust to this. All right, looking at the Fed balance sheet, where it continues to, by the numbers, it's going up, but it continues to look like it's declining as things are falling off the Fed balance sheet. And then this is looking at the year over year, where it looks like it's actually going up, but then we see a negative number here. So go figure, only a government chart can do this. And then we look at the overnight reverse repurchase agreements. This is not really moving all that much right now. So it's not really showing any real concern from the banking side of things. Now, looking at the advanced decline line based on price and volume, one thing that we're noticing on the daily charts, and we're also noticing it here on the weekly charts, we're holding up okay right now based on price, but we're seeing more weakness here based on volume. And we're seeing that theme going through a lot of our charts and the daily videos. That's a bit of a concern when volume tends to lead price down. It also can be beneficial when volume tends to lead price up. When we see volume going up and price hasn't caught up yet, well, we're seeing just the opposite of that right now. Just something that we want to be aware of here. But internally, we're hanging in there fairly well. Even with the down week, we saw in advance of the new highs, a little bit of an expansion of the new lows, but overall, the 4 weeks going up, but our 10-week is now starting to go down. And we did decline with the advanced decline ratio, but we're still above zero here. And we're coming down to the moving average. Now on the daily chart, we've gone negative, and actually we're looking extreme negative. We're underneath the moving average and getting kind of far away from it. Where here we're just coming down to the moving average. More weakness, and this will turn the accumulation distribution more negative. And this is a smart money indicator that we look at. All right, looking at our trend, where the green line's on top, but it's declining. We're also showing a weakening trend, even though we are still in a trend, because we're below the moving average. So it's positive, but a weakening trend. And the Erin, after giving us a really extreme reading, has backed off of that a bit here when it measures between buyers and sellers. The mass index is actually starting to tell us something on the daily chart. It's not telling us anything here yet anyway. And then here is the daily chart where we were hanging out around the 50-day moving average. We lost that in Friday's session. So in the short term, all of the indexes that are listed here are now negative. They're still positive in the intermediate and long term. So stocks are negative in the short term. Bonds have been seeing a lot of interest lately, so they're positive across the board. Where when we look at the short and intermediate term for commodities and the dollar, they are now in downtrends. No changes here with the decision point scorecard, even though there should be. The PMO in the short term should be negative, but they didn't come in and change that yet. And we're coming down a little bit, but we're still well above this trend channel going back to 2009. So right now, it's just looking like a normal pullback. We're going to be waiting to see. Is it going to develop into something more? The chart suggests we haven't done an awful lot of damage, at least to this point. The perma bears, they're just partying, thinking, okay, here we come, 50, 70, 80% decline from here. But there's just not a lot of evidence to really suggest that, at least yet. But things can always change. All right, here's a weekly chart. This is more negative. We were hanging out above this R2 level. We were able to get above that. Well, we dropped down below it. And so we did lose that longer term support level. And we're pulling back here, but look at how the red line's still going up. The 50-week moving average is still positive. And when we do the crossovers, we have dropped below the 13-week moving average, but we're still going up with both of these lines. And we're dropping below zero with the McClellan oscillator. We're also turning negative on the daily charts here. And that just shows that the market is currently under some pressure. And so we should be going down just a little bit here with the summation index based on price, but it's still above zero. And we are declining based on volume. We're also seeing, and for quite a while now, price had still been going up where volume was going down with this on the daily chart. And that was causing some real concern. And the bullish percent index actually got above 70 earlier in the week. It's still positive since it's above 50, but it has been declining. And then we look at the Swenlin trading oscillator, actually ticked up based on price. It ticked up based on volume, but is below zero. This is part of that negative divergence. We're above zero with price, below zero with volume. And momentum kind of chopping around right now. We were up based on price. We were down, but still positive based on volume. So we saw a bit of weakness here with the PMOs that are rising. The buy signals are declining, and the PMOs above zero are starting to decline on the weekly charts. We did see a decline here with the percent B after getting an extreme positive reading. We're still above the midpoint, though, but we are declining. And we're seeing trailing off here the chicken money flow. This is another smart money indicator that we follow. We've turned negative, but we're actually looking rather extreme negative on the daily chart. So the momentum, we're starting to roll over with the slope TSI, the MACD, looking a little weak here with the PMO, the PPO, but we're still pretty much flat with the long-term oscillators. And we're declining. And actually, in Friday's session, the chicken oscillator went up. Go figure that one. But we're declining below the moving average, or below the midpoint here. This is also another smart money indicator that we follow. The force index had been coming down and actually now is turned over negative. And we're declining, but still above 50 with the money flow. And with the 1 week rate of change, we are negative there. We're pretty much flat now with the 50-week rate of change. We're extreme negative with the Stochc RSI. We're coming down, but still, well, we're dropping just a little bit below the midpoint here with the Williams percent R. That's turning a bit more negative. We're still negative here with the special K weekly chart, where we continue to be positive with the daily chart. We're coming down, but still above 50 with the 14-week RSI. We're dropping below 50 with the ultimate oscillator. We're still positive, but coming down with the vortex. And the copy curve, after being positive longer term, is now starting to turn over negative. And it has been negative for a few days, actually a week or two on the daily chart. We did break below this 10-week moving average. That had been holding up as support. We closed just above that a week ago. We've now fallen down below that. If we see more weakness, we're going to be watching some of these other levels as possible support. And we're going back up with our 253 period equity put call ratio. Usually when that's going down, that's positive. With this going up, that's negative. We're also going up with our ratio between the VIX and the 3-month average of the VIX. That tends to be more negative. And we're starting to switch more negative on a trend basis here with the Heiken Ashi, with the dark candles. We're positive here, but we're pointing down with the Kigge chart. We're still positive with the Renko chart, but we're starting to turn more negative with the 3-line break. With the ease of movement, we did decline, but we're still above zero. And we saw a new O drawn in here, and now we have a new signal, a high pull warning, which was generated on the 29th of July. We're also turning more negative on the daily version of the point and figure chart, and we have a double bottom breakdown. I think that's what they called it there. We're seeing some weakness here with our momentum in the long term. We're rolling over, declining in the intermediate term, turning negative in the short term. And not sure where we're at here. We seem to have topped out just about halfway through the 50-day cycle. Probably for next week's video, I'll actually figure out what the date is going to be for the next time this cycle starts. I just use this as kind of entertainment. I don't really base things around this. But we're now negative after being neutral with the Elder's Impulse system here on the weekly chart for the S&P. And this is the second week now that we've seen the parabolic SAR negative. Now, we saw something very strange. In Thursday's session, we had enough of an up move where the parabolic SAR on the daily chart actually switched to positive, which is strange. But then in Friday's session, we had so much of a gap lower, it quickly switched back to negative. And you don't see one dot signals very often. Another thing that's a little perplexing is that we're seeing a negative sign on the daily chart with a dot back on top after being 1 day with a dot on the bottom. But the SPY, the ETF that's attached to the S&P, it's still looking positive. It still has a dot underneath. So there's a bit of a discrepancy there. Now, as I explained in the daily video, I use the SPY and I do a lot of the strategies based on the SPY, but I do my analysis on the SPX because the SPY is a derivative. It's an ETF of the S&P 500. There's supposed to be a one-to-one relationship there, but it doesn't always maintain that. And so like the 2 times and 3 times, I don't do real big technical analysis on those because they're supposed to be 2 and 3 times, either enhanced or inverse, but they can get out of line sometimes. And to base things around that, I you might do it, and that's good. And if you're comfortable doing it, keep doing it. I don't do it that way. I look at everything based around the S&P itself. Okay, so we are looking a little more negative now that we're into August. We're up 40% of the time from 2020 through so far 2024 with a monstrous 0.1% return. Okay, then looking at just the indexes where we are seeing a pullback with the S&P, we were looking better with the mid caps, but they got hammered this week. We were also looking better with the small caps. They got hammered also. But when you look at the Dow, we're still above the 13-week moving average, even though it did decline. The NASDAQ is falling below. We're seeing more weakness here. We're down below the 13-week moving average. We're also below it with the NASDAQ 100. And I tried to point this out a few weeks ago where we were going up and we had this really doji looking weekly candle where we opened, went up, went down, and then closed about where we were at. Sometimes that can suggest a reversal. Now we see another one of these just a few weeks before that, and we went up after that. So this is just something we keep an eye on. But this time it seems to have meant something where we got just about up to the, what is that, the 560 level, 500? I can't see the number there. But we've been declining since that point. Lately anyway. With the small caps, we're seeing some improvements, still in a longer term uptrend, but just got hammered, especially in Friday's session. And the mid caps also dropping below their 13-week moving average, but still in an uptrend. This is a daily chart of the Wilshire. We were hanging out around the 50-day moving average here, and that was giving us some hope, maybe that a base was being built, and then we were going to break up out of that. Well, we ended up being a plateau right here before we fell off the cliff, at least so far. And then the NYSE coming down right at its 13-week moving average, but still in an uptrend. All stocks pulling back below their 13-week moving average. The big software companies not really doing all that much here, but still in an uptrend. The FANG index dropping down below its 13-week moving average and could not close above its 50-day moving average on the daily charts. That was providing overhead resistance. ARC, of course, it had to be down. It's down when we have an up week and it's down when we have a down week. It was down almost 10% this past week and is in a longer term downtrend. And a weekly chart here, the bank index, we're coming down, but still above 50 with the RSI. And this area is holding up fairly well, but it did see some weakness. We're starting to roll over a little bit here with the momentum, but we're still seeing money going into banks for right now. And looking at just a weekly chart of Dow theory, where we came off, setting a recent all-time high, but pulling back. The transports has just been going sideways. Now, this could help the transports as a declining interest rate environment, but is it because of growth or is it to stimulate the economy? So they just have not been helping, where utilities are just back to rip-roaring to the upside. All right, then we look at commodities, which are still in an uptrend, but we're down 2.62% for the week. Oil is dropping back down into the 70s. We want to keep an eye on this. If things are starting to escalate again in the Middle East, oil may be a defensive play and start to go up. So we want to just keep an eye on that. In the meantime, as the market ignores what's going on in the Middle East, oil continues to drop into the lower part of the 70s. And the dollar is seeing some weakness, and we're getting ready to see a bear cross here, a death cross, with the weekly chart as the dollar's been under pressure, which often is helping support stocks. Copper coming back down. It was only down 0.5% on the week, but we had been seeing this coming down, and that usually means that it's looking at economic weakness, and that might be starting to play out. Let's see how we go with things moving forward. Gold, which of course everybody loves, and no matter what gold does, the gold lovers can justify it as being positive. And silver is actually below its moving average now, and it was up on the week, but it's been underperforming gold. All right, the bonds, we're just seeing a real move up here with the price of bonds. And we're seeing a drop off here with the monthly chart of stock to bond ratio. It's coming back down to its moving average, where we just got used to seeing this going up and up and up and up and up. Are we starting to see a change here? And we saw just a massive drop off in interest rates. This is a daily chart of yields. They really fell, and not only on Thursday, but also on Friday. There's a weekly chart where we're declining with US rates, and UK rates are also going down. German rates are going down. Japanese rates are also going down. So this is kind of interesting here. We're seeing gold now is doing the best year to date, And then even though they declined, stocks are in second place. Oil declined, but is in third place, but still up 10% for the year. And then the dollar has been dropping off, but it's still positive. But for the first time in 2024, the price of bonds has now switched over to positive year to date. We look at the ratio between the NASDAQ 100 and the S&P. Both have been under pressure, but the NASDAQ 100 has been going down more. Longer term, though, the NASDAQ 100 is outperforming. Also, the S&P 100 pulling back against the rest of the S&P 500. And we look at growth to value. It's still in an uptrend, showing that growth is outperforming, but we have been seeing a real pullback lately. And gold to the S&P, gold was up, S&P was down, but we're just chopping around with this ratio when you do the ratio together. And since the dollar was down and gold was up, we're seeing a little bit of an improvement here with this ratio. And then bonds are turning back up, but still in the longer term continue to underperform stocks. Low volatility, the S&P 500 shooting back up as the market potentially could be getting more defensive, but not enough to change this ratio. Discretionary is just really underperforming staples right now. And energy is actually doing a little bit better when compared to tech, but still energy is underperforming in the longer term. And then we've been watching the small caps to tech on a weekly ratio chart here, where it was really spiking up. It came down a little bit this past week, but when you look at the bigger picture, tech still continues to outperform and small caps are underperforming. And then looking at the NYSE breadth thrust, still working off of our major signal that was generated back in October of 2022. And the ZWAG NYSE, nothing really new to report there. This is the different stats going forward of how the ZWAG NYSE breadth thrust performed in the past. And we're still on a full-on buy signal here with the Zohorchak method. We're coming down, but still above the trend line going back to the 87 crash on the weekly chart of the S&P. So we are seeing a bit of a pullback here, but we have quite a ways to go to get back to the trend line. We're dropping a little bit below the trend line here with the weekly chart of the NASDAQ 100 going back to 2009. But we've dropped below that before, but this is just something that is a bit concerning. But if it can recover and bounce back above it, that would turn things more positive. And we're continuing to go up with the new highs and new lows on the NYSE. The broader market's hanging in there. Even in Thursday's decline, we had the NYSE bullish percent index getting extreme positive. So that just shows that the broader market is hanging in there better than the mega caps right now. So we're still going up with our 50-week moving at 50-day moving average here. This is a daily chart. And so that's still looking okay. And then we look at that same thing, but based on the S&P 500, where this is continuing to go up as well. So internally, we're not seeing a lot of meltdown, at least yet. And then we look at the NASDAQ 100 to Dow ratio. It did come down, but it was still above this ratio that we saw here that was supposed to be the death level that may still happen, but hasn't happened yet. And we look at the Qs to the small caps. It had been dropping down as the small caps were outperforming. We're starting to go back up. Even though the Qs were weak, the small caps were even weaker. All right, and then the semiconductors to the Dow. This is dropping down below this blue line right now. We just want to keep an eye on this area as well. This is also showing the cumulative new highs, new lows for the NASDAQ. It's really hard to see, but it's going back up. And then we look at a daily version of that where we're below zero. So that is negative. And then this is another area that we want to keep an eye on. The 3-month yield, it's really starting to drop. You notice how it really dropped back in 2007, right before the great financial crisis? We don't know if that's what's going to happen here. We've been going sideways, and we've just been kind of boringly looking at this chart for a long time. Now that it's starting to break lower, is that a cause for concern? And then, do we have a new Hindenburg-Ullman signal? Not yet. But this is a one-day lag here. We won't have Friday's score until after Monday's session. We saw the initial signal. It needed to be triggered by August 2nd to be legitimate. Of course, the perma bears already see this as a full-on signal, but we do need a confirmation for this to be legitimate. All right, then we do have a confirmation here with the NASDAQ, but there's other times we had confirmation and the NASDAQ just kept going up. And then we look at seasonality. We're now into August, where we should be seeing this nice little bounce. Doesn't it feel like it? Aren't we just going to the moon these days with stocks? No, we're going down right now. We do see a trailing off of the performance of August compared to July, but it still is positive. And August, when you look at it on a global basis, this tends to be the weakest month of the year. But when you look at the US during an election year, June, July, and August are positive historically. And we do look positive here going from 1928 to the present, but it's September and October where we start to see a little bit more problems on a historical basis. And then looking over the past 20 years, this is July. That should not be here. Now we're looking at August, where the first half, little bit of a return. We tend to see a little bit better performance in the second half of August. And then also looking at August during an election year, we're up 11 out of 18 times, down 7 out of 18 times with a return of 1.3%. So thank you. I really hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.